Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. Really excited for my next guest. His name is Sam Silverman. He is a tech sales executive turned real estate investor. He's also a capital raiser who reached financial independence before turning the age of 30. After leading a 100-person global sales team by age 23, he took the skills he built in tech, systems, communications, and scale, and applied it to the real estate business. He's since invested in more than 60 deals and raised over $70 million in private capital. Today, Sam is the founder of Silverman Capital, a firm that connects investors with proven real estate operators. He's also the chief investment officer at Kudo Capital and owner of Forward Firm, where he helps investors grow wealth through clarity, alignment, and intentional strategy. Welcome, Sam. Thank you so much for being here.
Yeah, thanks for having me on.
You got it. And we were just talking, you're down there in Miami, Florida. Is that where you're from originally, or did you grow up someplace else?
No, originally New York, went down to Tampa for college, and then stayed there for quite a while, then moved down here late last year.
Very cool. So you went down there for college, and you cut your teeth in the corporate world first, rather than jumping straight into real estate or entrepreneurship. Was being an entrepreneur always part of the plan, or did you change over time?
So I was an entrepreneur a lot earlier on. So I actually built and sold my first company in high school. It was an event planning company that I built. We would do teen nightclubs in New York, rented a big event space. We had people selling tickets in every school. That was my first time leading salespeople. And that grew pretty extensively, right? So we built a really big event space. We scaled it up pretty well. I mean, I think our biggest event had 1,600 people, right? Like they were decent size. Ended up exiting the company as I was leaving the city. And from there, took a lot of time off and had no clue what I wanted to go do, right? Played baseball in college a bit. And then, started thinking, okay, I have to get an actual job here, and ended up in sales. So I started out in inside sales, pounding the phones, right? The lowest of the low in terms of roles in the tech space. Over time, I knew I wanted to do something for myself. It's a matter of what. But being in sales thing is the quickest paths to go actually earn while you figure out what it is that you want to go do, right? So for me, I'm like, okay, if I have no clue what I want to go do yet, when I do figure it out, the more money I have, the quicker I can then go once I do figure that out.
Absolutely. And sales is one of those skills that applies everywhere. No matter what we're doing, we're always selling in some way or another. And even people that aren't salespeople selling a product or a service are selling themselves and selling their ideas. And, it's a way of moving up in a company, because you have to, position yourself and get your message out there and get it heard. And that's always done through some sort of a sales strategy.
Yeah, I think it's one of those skills that applies across every area of your life, right? Personally, professionally. It's also a field too that it's a meritocracy in the right companies, right? There's a lot of fields in which it's based on, Joe's been here for 10 years, you've been here for 5, Joe gets the promotion, right? Where in sales, it's very much you're so close to revenue that if you perform well, 1, you're directly paid more, but 2, you likely have opportunities that keep growing and growing quickly. You can either go sell bigger deals, you can go lead bigger teams, right? There's different ways you can go move up. But it's one of the few fields in which I found is that age and seniority actually aren't as heavily weighted as there are in many other fields today.
Yeah, it's true. And, sales is definitely, it's a skill, but there's a hustle to it too, right? And it's going from, just starting the conversation to earning their trust, getting them to know, like, and trust you, and then doing the close. How much of sales do you think is just pure hustle, and how much of it is the skill in getting that closing?
So I think it depends on what kind of sales that you're in, right? When I first started, I was in inside sales, meaning that my sole job was go find people who fit a certain profile of our customers, and then go book appointments with them and go pass those appointments off to a more senior seller. So looking at that function itself, that role, in my opinion, you can go outwork your lack of competency with pure effort, right? It's very much an output type approach, right? If you're willing to go do more effort, right, you likely can have better results overall. It's an equation, right? Your output versus your conversion on that. I'd say as you get into more and more strategic type sales, it's much more finesse than it is effort, right? I think there's effort that can help you be more, have more finesse as you're doing it. Like, for example, I worked in a bigger company. I led their whole sales development team. And we had sellers who we'd support who were selling the Deltas, the Verizons of the world, right? More effort selling accounts like that isn't going to do it. That's much more so being very intentional, being very direct, right? Being very thoughtful as to how you go approach them, and very tactical as to how you go help their organization come around you to go help support that transaction. Because that's not a one-person sale. That's a 20-person team sale, right? So what I'd say is that the more you move up and sell bigger deals, the less it becomes an effort game and more it becomes how thoughtful, how creative, right? How your ability to go mobilize and act as your own CEO of your sales org in that company.
Is this where buyer profiling comes in?
Yeah, I mean, buyer profiling, I think, comes in at every stage of sales. Just they're more broad as you go in more volume, right? Like for me, or our team, say we were targeting people who are in sales or marketing, right? You have a very general profile of that person. You would think about what do they make, what do they do in their free time, how do they think, and then this gets infinitely more detailed the more you actually know who that person is. So, for example, if you're selling Delta, and you know that you have to go target their, chief experience officer, you can go down to the exact person and put meaningful effort into that single person. Where because that one transaction that you win can be 3 years of your compensation in one deal, right? Whereas if it's more of a volume game, you have to do it more of assumption based, right? Versus really getting down to know that person. So I'd say it applies in every area. More just a matter of how deep you can go based on the volume and level of the sales that you're in.
Right. So what's the deepest you've ever had to get into research on a single person? Like how far did you take it to really get to know the person that you were going to sell?
So I think of that more so now versus in sales, right? So now if you look at kind of the roles I play in deals, right? I partner with a few key operators across different types of projects to go help them scale and raise their fund. So for example, I think the biggest thing you're profiling now is who your partners are, right? So less so a sales approach, more so truly understanding the partners, the business, the aligned interests, right? So I'd say it ties there more so than it's tied into the world as related to a single person in sales.
Got it. So in your previous life then, did you, like, how far have you taken it to learn who it is that you're talking to? Like, have you, you Google them, right? Like, that's kind of like the basics. Did you, do you go and troll their Facebook page, look at their social media? Like, how far are you willing to take it so that you can learn the background of the person that you're talking to?
Yeah, so on my end, I was never in super strategic sales myself, right? I was more so leading teams that were more volume driven.
Okay.
Right. So it was more so teaching people how to do, I look at it as like, to give an example, how to get a B as quickly as possible rather than needing to get an A, right? It's usually a Richter scale. So for example, it may be exponentially more work to get an A in that scenario versus getting a B, but a B would still pass. A lot of the work we did was more so done, not perfect, to get Bs because you could do a lot more volume that way. When you're hunting for new logo sales, you have a giant prospect list to go target, right? These weren't super strategic type sales we were doing. These are much more so volume at scale, new go-to-market type opportunities. So for us, it was how can we still be really efficient, but still get enough to be dangerous in that conversation to be better than most people who reach out to that same person as well.
Got it. And so now you transitioned into the real estate world. And you dabbled in sort of like single family rentals for a while. That was where you got the taste of real estate, but something changed there for you where you said, okay, I don't want to be a landlord. I want to move into capital raising and syndications. What happened there in the middle?
Yeah. So in sales, it was, at least for me, it was a space that I can go double or triple my income for a period of 3 or 4 years, right? My lifestyle did not change much. So in turn, you have meaningful dollars to go invest. And I thought of passive income as owning single family homes. I was very wrong. And for me, like each home that I was buying at the time, you make a few $100s a month on, you have one thing that goes wrong, you're wiped out, right? And each transaction was such a massive lift for me, right? Being in the role that I was in the corporate world at the same time, if I nailed my day job, I could go out and make $700,000, $800,000 a year. If I didn't nail my day job, I could make about $250 a year and be close to getting fired every single week. So for me, the opportunity cost wasn't the actual properties themselves. It was what was I giving up to go do that, which was substantial. I was better off nailing my day job, being less stressed out, right? Having a clearer focus and taking those incremental dollars and just investing as an LP in those deals. So in turn, I sold the entire portfolio off to Zillow. They were still buying homes at the time. And I moved quickly off those. I started investing into a bunch of deals as an LP. And what I found was that there's really two key drivers in the project, more so three, but kind of two entry points to get into a deal. Either you, one, find deals, or two, you find capital. Obviously, third is operations. Operations is more so once you actually have those first two things. So to break into the space, it's either deals or money. And for me, I let much more so to the money side, being that I can go hunt and go prospect, right, and go speak about what I was already doing myself with my own cash. So transition to partnering with operators I've invested with, right, in a, call it fund to fund capacity to go bring capital to their projects. And I've since done deals across most asset classes you can go think of. So all across real estate, private equity, private credit, debt. So a lot of different avenues there as well now too.
Gotcha. And so now you've got your own fund, or actually, is it a fund or the Silverman Capital, where you said you align people with proven operators? Is that a fund to fund?
So we've done deals in a fund to fund capacity.
Mm-hmm.
Now I've actually kind of transitioned to doing way less volume and doing the entire capital stack of projects. So for example, like my biggest project right now is Kudo Capital, which is a private credit fund. So Silverman Capital is not really there. It's more just myself, right? One of the four partners in that project itself. I kind of own the entire piece of it as it relates to all things capital, investor relations, go to market, positioning, structure, etc.
So explain what private credit is. So I know what private capital is. What's private credit?
So think of private credit, at least in how we're using it today, as this is money that banks may not lend on today, right? Giving people financing that, or giving businesses financing that banks may not or don't do today. So for example, right, we can fund a business for working capital in 24 hours, right? Maybe 48 on a slower day. Businesses may have a need because they have inventory they have to go buy. So you have a HVAC company that lands a new order, right? They have to go fund that order and they're not getting it up front from a customer. So it's working capital, lines of credit, operational capital for businesses. So on our end, how we've thought about it, how we've structured is that, our sister company is a brokerage in this space, right? They broker $25 million a month to third-party funders. On our end, the private credit fund is meant to go take a portion of that volume and bring it in-house on our own paper. And in turn, we can offer very, very high yield to investors, which in the real estate world, what we've seen the last while is that yield has become very tight, right? Especially in the syndication space. Is that so for operators, right? There's not much money for them to really go earn in that spread. Make your acquisition fee. You then hopefully have an AUM fee. And then from there's not really much margin left because you're just actually hitting the pref itself or very, very close to it. So we really feel that this space is, one, it's very needed for businesses, but also two, it's a really unique offering in the market right now relative to potentially real estate type offerings that are out there.
Interesting. It sounds like it could be a little risky because part of the real estate, the thing that's good about real estate is you can securitize it with the real estate. And so you've got some backing there. How do you securitize a loan to a business?
So how they're structured is that what we're doing is we're essentially buying their future cash flow at a discounted value versus what it is today. So across our portfolio right now, we're less than 10% retrieval rate. What that means is that the business is doing $100K a month. At most, we're taking about $10,000 from them a month to go pay back the funding itself. So it's tied to their future cash flow, all based on historicals. Business itself on the sister side has brokered about 12,000 customers. So we have all this historical data that we can take in. We can say, hey, we know what industries, what types of data that we need, right, in terms of cash flow, credit scores, time in business, industry, geographical area that makes the quality funding. So to answer your question, it's tied to their future accounts receivable. And then it's a personally guaranteed by the business owner in that scenario as well too. So yes, there's more defaults, right, than say, other debt funds. There's also a lot more margin too. For example, right, our fund can be impacted. We can have about 24, 25% of our capital that's lost, right, that we put out, and still hit our full 60% return to investors, where historically we're between 4.5% and 6%.
Interesting. So that's why you think this is you can give a better return to your investors in these funds than somebody who just invested in a normal syndication.
Yeah. So our goal here is we can give equity-like returns, right? If you look at, say, class B, C, maybe in some low A multifamily right now, most IRRs are modeling to a 14 to 16%, right, over a 5-year period. On our end, we feel like we can give equity-like returns with a 1-year lockup only versus 5 years, with all the pay and current cash flow, and having that level of liquidity. Also, when you look at aligned interest too, is that we don't make $1 ourselves at the GP until the entire 16 to investors has been hit. We have no acquisition fee, no AUM fee. It's all structured as pref equity. It's paid entirely first, and it's a portfolio across every funding that we do. So, for example, someone investing may have their money across 100, 200, soon to be 1,000 different fundings that they're kind of owning pieces of.
So it's a shorter term investment. You said 1 versus 3 to 5 years with a normal syndication, and you said there's also liquidity, like they can get access to the funds.
So it's an evergreen fund, which means that it's always running. We have a 1-year lockup. So if you invest tomorrow, right, your money is tied up for 1 year. After that 1 year, we say, if you reach out to us saying, hey, you know what, I need this back for whatever reason, we have 90 days to return it to you. So it's 1-year lockup, 90-day liquidity. The fund itself keeps going. So we have plenty of folks who plan to keep their money there past the year. You just have the option after that year is up to go call it back.
So let's say an investor comes in and invests in one of your funds. They have $100,000. They give it to you for a year. They want it back after a year. How much do they get back?
They're $100,000. There's not a level of appreciation to it, but they begin their monthly payments of actual distributions on top of that. So all the money that is being made is already sent out. Whereas in, say, real estate, what often happens is that you get very little cash flow in the hold period, and the bulk money is tied to the exit. All the cash flow on our end historically has been current, meaning that if our share classes are 100, 250, and $1 million, we're at 10, 12, and 16% respectively. So say you're in that, you put in 250 and it's 12%, right? If we're hitting our target, we're paying you $2,500 per month, right, in yield. So 1% per month, 12% per year in that structure. When you call your capital back, all we're doing is returning you your 250.
Got it. So you give a higher interest rate for the people who were willing to commit more. That on that $1 million level would be the highest amount, the 16?
Yep. So we actually have a lot of fund to funds, SPVs that invest into the fund itself. And the reason is that, a lot of co-GPs or capital partners in deals, they make their 2% up front in a deal typically, or they're part of the acquisition fee. And what happens is that they know their income for a period of 3 to 5, 10 years in that deal if it hits the pro forma itself. So in turn, what we see happening is that a fund manager may come in and raise $2 million into this project, right? We're paying 16% target returns to them. From there, they can do whatever they want to with their investors as long as the investors agree to it. If it's 11, 12%, so they have that spread of 4 or 5% a year of current interest that they can then take as margin for themselves, right? So making that spread between those shares. So for them, it allows them to go build up a level of recurring income as a fund manager or capital partner that pays them every single month when looking at the structure around it.
Interesting. And so you've niched your target audience, and I think I read that it was for like tech entrepreneurs. Is that some of the people that you're bringing into the fund?
Yeah. So on my personal investor base, right? So we work with both retail investors from my network who kind of tie more so to people in tech and software and a lot of sales folks as well. Also to fund managers, right? We kind of built this in mind where that spread between those share classes is large enough where it's appealing for a fund or a capital partner to go come in because there's enough spread there for them and margin there for them. We felt as though it solved a need in the market for current yield and a way for fund managers to earn on what they raise today.
Gotcha. So you said you've raised money for lots of different asset classes. What are some of the ones that you've done in the past?
We've done single family, multi, storage, mobile home parks, RV campgrounds, debt, credit. We're finishing with a fund right now that's buying paving companies, like paving and asphalt. So Yeah, a nice variety. I think on my end now, the private credit's the biggest opportunity by far. But we still do like things in like the private equity type space. I think it's a really unique space too. If you look at it, of kind of consolidating these micro cap service companies, right? Because you can go out and buy a company for 3x EBITDA. Once you get a level of scale, say you get to about $10 million in EBITDA as a portfolio, the portfolio itself is congruent, right? Operations, marketing, systems, process are all dialed in and aligned. That may go from being worth 3x to being worth 6x, right? There's very few assets in real estate you can go buy where your cap rates can be cut in half if you get a level of scale. So for us, we see a big opportunity to both increase revenue, decrease cost, but also get a big level of expansion. Is all these mid to large private equity firms, they can't go deploy a check of 2 million, 5 million. They have to write checks of 10, 20, 30, 40, 50, $100 million at a time. So for us, they'll pay a premium for having people like us do the legwork of consolidating and scaling those portfolios for them.
Yeah, so you're looking for companies that have already kind of gotten to the point where they're generating enough revenue. Do you guys look at early stage startups as well? There's a lot of money moving into the AI space right now.
Yeah, that's not for me. That's not for me personally. I think we like things that are cash flowing today, right? There can be money made in AI, but it's not going to be for me.
Yeah, it's risky, right? They're looking at 1 out of 10 maybe, making money, whereas you're bringing other people's money in, and you've got a proven model on what's working. And so I like that approach of working with people who've got maybe some of this extra capital that they could move into these things. What do you see coming down the pipe as far as like new projects? Is there anything that you're excited about?
Honestly, the private credit is the biggest thing.
Yeah.
We're going very, very deep in that. I think it really fits a need right now, especially as treasury yields keep getting pushed lower and lower. I feel like for us, we can go carve out a really nice niche. And I think what you're going to see is that banks will become tighter and tighter with lending, which in turn makes the product itself more desirable. So I think on our end, we've got a lot of runway ahead of us with this offering itself. And the other things we can go do with the same underlying asset, we structure a bit differently. But for us, I think the income fund itself right now, of how we're structuring it is, it fits the market, right? In terms of need for investors, in terms of opportunity right now. So we have a lot of runway here with this. And I'd say alternatively, looking at, more service companies potentially, right? Like I own an accounting firm called Forward Firm that fit within the kind of underlying hub of ecosystem that we already have today, right? There's things we more own personally, no investors. I think things like that fit really well. We're always open-minded to. But I'd say right now, I think private credit is the biggest opportunity, especially on a risk-adjusted basis, in my opinion.
Yeah. So I think that would definitely benefit a lot of the companies out there that can't get loans from a traditional bank. How do they find you? Like, are you advertising, or how are you getting this opportunity in front of them?
So the sister company, right, there's 4 partners in the credit fund, myself, actually 3 brothers. 2 of those brothers actually own one of the top brokerages in the space right now for actually sourcing and driving those leads. So on their end, they've got a database of 120,000 companies. They have 12,000 plus customers already. Actually, over half the fundings they do come from their current customer base. So on our end, right, it was kind of the equivalent of being a huge property manager, knowing the ins and outs of it, knowing all the assets, knowing how to go manage them, and saying, hey, you know what? Let's go buy our own deals. So similar progression on our end of saying, hey, we know the space inside and out, have all the data, the systems, the connections, right? On our end, we know what to go pick for the best fundings. Let's go keep those in house right now.
Yeah. And you like to personally invest alongside your investors as well, right? Because you're looking at it from both an LP perspective and a GP perspective, and you're willing to put your own cash in the ones that you believe in.
Yeah, I mean, I have money in every deal we've ever done. I have personal cash into, right? So I
Do you
kind of
think that
started
makes
out
a
as
significant difference in the fundraising aspect, where you say, I'm also invested in this deal? Does that sort of push people over the edge?
I've actually gotten asked that less and less over time. I think at first, when I was first starting, it came up really frequently. I think now, especially doing less offerings, like at first it was tough because we would do such a volume of deals that I had to go really small. Now I can be one of the biggest investors in each of the funds that we're doing, right? So that becomes a meaningful type thing for us where, we believe in it. We have to put our own money somewhere as well too. And I think it's just easier, it makes your life more simple having money in your own businesses.
Yeah. I mean, it makes a lot of sense because if you wouldn't invest in it yourself, it makes it that much more difficult to convince somebody else to put their own money in. I see a lot of GPs that don't. They don't put their own money in their own deals.
So I think early on, that's fine. I'd rather, especially after the last cycle, have a GP who's more liquid and they have more cash into the deal itself. Rather than be the first stopgap when things go south. Rather than be able to go have resources to go support things versus they're tapped out and they need to go do a deal for cash and they forget about the deals they've done. Obviously, both is better, right? Having cash in and also having backup cash as well too. But I think the GP's balance sheet matters more and more as the last while.
Yeah, because there's no shortage of opportunities out there for investors, and they are going out and they're shopping and they're comparing one opportunity to the next. And they're comparing one operator to the next. Do you have that happen to you when you're raising funds where they say, hey, do you know anything about this opportunity or this operator? And then you have to kind of compare yourself to them?
Occasionally, I'd say it's more so tied to the actual, like right now in the credit space, right? There's other offerings that have, similar type structures to what we're offering. They maybe have underlying assets that are different. They may have different, waterfalls and structures. So I totally stick to it more than that, right? Versus like another operator themselves. Yeah, I mean, we don't really get a ton of comparison against people. I think it's more so this is a newer asset class people are getting comfortable with. I think it's more so understanding the asset class, understanding the underlying assets itself more than anything else.
Yeah. Yeah, there's also challenges here. I remember reading something that you mentioned before about experiencing losses in deals that have stacked preferred equity layers. I didn't really know what that meant. Can you explain that to me?
Yeah, so if you look at preferred equity is another form of leverage, right? Typically, you'll see a current pay, right? Say it's 8 and 5. 8% is paid current, 5% is accrued and paid at the exit, right? Really common in, say, multifamily. What happens is that money typically is paid out prior to other LPs being paid out in common equity. If that deal itself performs at, say, a 20 and the pref equity is capped at a 13, the other 7 points they would have earned flows back into the LP and GP structure, right? So there's more profit there for them. If that deal performs at a 6, right, the pref equities can go eat up a lot of that return that would have gone to the LPs therefore behind it. Instead of getting a 6, maybe they're getting 2 or 1, right? This also matters too if a deal loses money, right? As the pref equity is returned their capital ahead of the LPs being returned and their common equity being returned their capital. So it's a lever that can be used. It also depends how big that stack is. So for example, if the pref equity makes up 10% of the capital stack, not significant. Okay. If the pref equity is half the capital stack, very significant, right? So what I'd say is that it's basically another form of leverage that's used in deals to go make things pencil, right? Or to get bigger checks, right? So you're seeing groups who invest a ton in pref equity. They're great deals to invest into. You have less risk, you're higher in the capital stack, and your return is not usually that far off what the common equity is getting. So in most scenarios, being a pref equity is a good scenario to be in.
Yeah. Yeah, I can see that be a sticking point for some funds that are structured that way. And, you've been through all different kinds of structures up to this point. So you've kind of perfected the process. And I think there's a lot of people here who is probably interested in this, preferred credit model. What kind of investor should consider an opportunity like that versus putting their money into a syndication?
Yeah, so I'm going to play both sides of it, right? We're kind of looking at different points of view. I think in the syndication side, a big appeal that you'll have is the tax piece of it, right? If you can actually go use those passive losses, most people cannot, right? You typically see syndicators blasting where they have these losses you can go use. Most people, if you don't qualify for REP status as a professional, you cannot use those losses to offset other gains, right? So usually it's just in a bucket that you can't use. On our end, right, we do fall into the ordinary income tax, right? So there are potentially higher taxes in the yield you're receiving. Alternatively, I think a big thing too is the lockup period, right? If you may need money in 3-4 years, right? Having something more liquid, in my opinion, taps into a different bucket of capital, right? For example, if you have $1 to go invest, one of my good friends, He runs a shop that invests in multifamily in Texas, Houston, Dallas, San Antonio. And for them, they know that market in and out, right? But if you're an investor, you may only want to have so much money with them in that market, no matter how good you think them or those deals are. What I say alternatively is that we kind of figure ourselves in a bucket of very consistent yield, very, a lot more liquidity relatively, right? And pretty stable overall. I think it's also important to think about the how an operator gets paid. In our structure, we don't make a dollar, no fees, no split until the entire 16% is achieved to investors. So for us, if that deal performs at a 15, makes zero. In say multifamily, there are groups now charging 3, 4, 5% acquisition fees, massive EUM fees. So it's understanding how that person gets paid as well. For us, we only do this for a very, very long time. So incentive wise, we're making so that we don't make anything unless we deliver fully to our investors in that sense too. So what I'd say is that it depends on what it is that you want and what it is that you need. But I feel like for us, we really solve liquidity, current cash flow, and align incentives.
Yeah. And it says a lot about your faith in the model and your faith in your team to deliver on what you say you're going to do. And I just know that a lot of GPs can't do that. They don't have faith that they're going to deliver. So that's why they take out their fees in advance, because who knows what's going to happen in 3 to 5 years. So I can see that being a huge benefit to your investors.
Also, one more point too that you mentioned too is like when you look at say where the market is today and kind of how uncertain, right, the things can be in terms of economy, in terms of politics, right? On our end, our average funding length is between 4 and 12 months, called an average of 9. On our end, we can then see, hey, is this geographic area being hit? Is this industry being hurt? We can go quickly pull back in certain areas and reallocate very quickly in terms of our portfolio itself. Whereas, say you own a property in this market in multifamily, it's very tough to liquidate an asset. You have holding costs, you're likely underwater on it when you first buy it. It's a value add type strategy. You have transaction costs. So on our end, we're a lot more agile as it relates to reallocating part of our portfolio very quickly through new fundings that help pull risk back based on where the economy itself is going.
Yeah. That's definitely a huge benefit. Like you said, things are changing so quickly right now. And there's a big driver in it. We mentioned AI earlier. Who knows what's going to happen in the next 3 to 5 years? If your money's tied up in, some city, someplace, and one property, and that city takes a huge hit financially or economically, then, you have no control over it. So I like that benefit as well, that short-term, liquidity. And then they can just roll it over if they want to for the next year.
Yeah. And we typically see people leave cash longer than expected, right? I've had money in the fund like this myself for 3 or 4 years that just kind of stays there as my liquidity. Yeah, I mean, it's definitely a big thing to be able to go reallocate and pivot based on where things are going. I'd say it's your comment about AI as well, is that 95% plus of our fundings, if not even higher than that, are tied to places that have a physical shop, right? Like they're a service company, they're brick and mortar in some way. These aren't things that are going to be replaced by AI.
Right. And that's intentional. Was that a decision you guys made initially, or is it something that you've kind of pivoted to because things are changing so quickly?
It's something we've always done historically, but I think it really helps revalidate and reinforce the decision to do so based on the stickiness of those companies, right? There are, tangible assets, tangible cash flow. They're not always essential companies, but they're pretty close to it, right? They operate based on services, and we feel confident those businesses will keep going for years to come.
What are some examples of those types of companies?
Yeah, so in the last week, I'll actually pull it up. Might be 1 sec, I'm switching screens. So last week we funded a landscaping company, a charter bus company, a bed and linen manufacturer, a lodging resort, a stair manufacturer, an auto tire repair shop, a catering event space, and then 2 roofing companies in the last week.
Wow, that's all across the board.
All across the board, and also across, I want to say, Alabama, Colorado, California, Wisconsin, Georgia, New York, Indiana, Tennessee, right? So we're all over geographically as well. So what it allows for us to go do is that, our average funding right now is called between $50,000 and $60,000, right? Our fund itself should hopefully be about 25 million by the end of 2026, meaning that we'll have, 500 different fundings across the portfolio itself active at any given time. So what it allows us to go do is have diversity, right? So that we're in different states, different lines of business, right? So all those different areas that allow us to get more diversified as well, that an investor can get for one check in terms of exposure.
Right. And that investor's money is spread across all those different business lines as well, right? Do they get an opportunity to select where their money goes? But once they put it in the fund, it's up to you guys to invest.
Yep. So we have parameters in terms of things that we follow, right? And on our end too, like we always go back to it as if we don't perform, we don't make any money ourselves, right? Like this is what we do in terms of the bulk of our time. So for us, like we're very stringent on the criteria. I think a big thing too we have an advantage of is that we have all this historical underwriting and data from all our previous customers on the brokerage side. So when a deal first comes in, right, people submitting for funding, all of it goes through this like AI-driven automated type underwriting. From there, we actually bid that out to third-party funders still. We still work about 20 funders. The ones that actually they bid on, we can then have our team underwrite really quickly to see if they actually fit our criteria. We have in-house underwriters, we have third parties that review them, and we have all this AI automation data we use internally to go see which ones make the most sense to put our people against.
Very interesting. Yeah, that's different than it's such a huge volume play, right? Because a lot of these other funds, they're doing 1 deal, 2 deals a year, right? And that's all they're working on. And if they make one mistake, everyone in that fund is going to feel it. But you're right. You're hedging your bets. You're hedging all of these different lines of business and then the different geographical areas. Anything in other countries, or is it all in the United States?
We can fund, I believe, in 47 out of 50 states. So all continental U.S. There's one state right now, I believe, we're working through some logistical pieces of. Besides that, we fund all continental U.S. So nothing out of the country, nothing in Hawaii or Antarctica.
Got it.
Or sorry, Alaska.
Alaska, yeah. Well, that's cool, Sam. I mean, this is an exciting opportunity for people that are out there. So anybody who's listening, who's interested in, would it be Kudo Capital they would be looking into?
Yep. Kudo Capital.
How do they find it? How do they do some research? Can they contact you directly to learn more?
Yeah, so I'm super active on LinkedIn. You'll see me there, Sam Silverman. So feel free to reach out. That's probably the best place for it.
Awesome. Well, Sam, thank you so much again for coming on. I really appreciate it. I know you're super busy. And yeah, anybody who's interested in checking this out, go to Kudo Capital. You can find their website, or you can find Sam on LinkedIn as well. And you can get more information about his different investment opportunities. Sam, thank you so much.
Thanks so much for having me on.
You're welcome. You're welcome. And everybody, thank you so much for listening to this edition of the REI Hacker Podcast. Keep an eye out for more amazing guests like Sam in the future, where we talk about wealth generation, real estate investing, business, entrepreneurship, and the like. But thanks for listening, and we'll see you guys next time. Take care.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.